Welcome to NAAIM Confidential episode number 29. I am your host, Ben Fox, and today I have the pleasure of introducing our speaker, Jim Bernstein. Jim is the founder and head trader at QEX Asset Management. He is a seasoned capital markets expert with nearly 40 years of comprehensive experience in trading, risk management, and investment strategy development. Jim, thank you for joining us today. I'm excited to learn more about what you do and where you see the market going.
Thank you for having me, Ben.
Definitely. Well, I like to start off with the name exposure index. So I'm going to get that pulled up here on my computer. And as a reminder, the name exposure index represents the average exposure to US equity markets reported by our members. So it looks like this week we're coming at 76.70%. Last week we were at 87.94. I'm not surprised to see it going down, especially after the week that we had within the equity market with tech and all that. Jim, what are your thoughts on this? Are you surprised to see it go down?
I'm not surprised to see it go down. It's an interesting number, the name index. I actually took a look at it from the standpoint of a technician and a quant, and just tried smoothing a little bit with some moving averages. And if you smooth a number out, you get something that is often either leading or coincident with the market. It very rarely, every once in a while, it'll lag, but it's quite an interesting tool. This looks like this time on this pullback, it was a coincident indicator. We're bouncing back. Market's bouncing back a little bit this week, but I'm not surprised to see that number go down. The name number go down along with the market. Because for the most part, for the most part over the last few years, it's really been a coincident indicator. So they tend to move together.
I like that. Do you contribute to the name exposure number?
I do. I've been making a habit of contributing regularly.
Are you above or below the 76 right now?
Right now, I'm actually way above it.
Okay.
Right now, so we'll talk about this a little bit later. The two main things I do are bond market timing, which is not appropriate to report for the name exposure index, and then on the equity side, there's not a lot of timing going on there, so that's also not appropriate. But in my play account where I manage just my own money. There, I do whatever I want, and there I am, I think about 150% leveraged as of a couple of days ago.
Got it. Yeah, we're in the scarecrow space, which is always leveraged, and we're either 200% up on this flat or 200% inverse. So we're still all in at this time as well. So we're on the same side, you and I. Do you want to go in? I know you have a presentation for your equity and bond. We can kind of run through the bond in the beginning and then go to the equity if you want to start sharing that.
Sure.
So I'll take my screen down and you'll be good to share.
Okay. Yeah. So as I mentioned, I've got two different active strategies, and the first is the bond market timing, and that's been my bread and butter. That's what I've been doing. I started back in 1980 something on Wall Street as a government bond broker, and got my chops there, and basically have been a bond manager for almost the entire time that I've been doing this. It's only been the last couple of years that have been working a little bit more with equities, but the bond market timing is exactly that. It's either in or out, and I use junk bonds, high yield bonds, as my main vehicle for timing them. That's sort of what people I think traditionally think about market timing. It's either in or out. Like you mentioned with a scarecrow, you're in, you're out, you're leveraged or not. In an ideal world, we would be timing with mutual funds, but the mutual funds don't like it so much when you time their mutual funds. So the last, I don't know, 5-10 years, we've migrated over to ETFs, which don't time as well as the mutual funds, but they time okay.
Yeah.
The the issue with the bond market, though, and getting into sort of a broader market view, is that spreads are so incredibly compressed in the high yield space. And I had a chart, but it's on the other computer, so I apologize. But if you look at the spreads for the Merrill Lynch High Yield Bond Index, as of I think it was Wednesday, it was down to like 308 basis points, which is ties the low for about the last 5 years. And the only time it was lower than that was back in, I think, 2007, 2008. So there's not a lot of risk premium being demanded by junk bond holders. There's not a lot of risk premium there at all. There are a bunch of different reasons for that. Some of it is, um, reliance on private lending. There's less public high yield available, but it's also part of it is this, I think, this feeling that the Fed's always going to be there. The Fed's always going to bail people out. So why not take the risk and then and worry about it later and kick that can down the road. So the spreads are very low, and that that concerns me a little bit because um, it may be true that the Fed's always going to be there and have our backs. Spreads could very well blow out too, and they're well below average. So the risk reward ratio in the high yield bond market is a little bit it's a little bit concerning to me right now. So playing in there, and that's sort of our core strategy, but always with an eye towards the exits.
Well, got it. Well, whenever I think of bonds, I always think back to it's pretty recent now, 2022. How did you guys do in 2022?
2022, we did okay. It was not a bad year. I was with a different firm then, but we all private accounts. That was before I started this firm, but we made we hit our target, which is usually to get about 5 or 6% above money market rates.
Okay. Yeah, got it. Well, cool. Well, I mean, I'm not the most versed in the bond market, so I'll probably have a lot more questions when we get to the equity side. So if we want to jump over to that.
Sure. The equity side, I wrote buy and hold ish.
Yeah.
I don't have a traditional timing model like I do for the bond market. I'm not in or out. Um, the what I do have is a filter uh, on the selection process. So as it's constructed now, the equity model picks 5 stocks every day, and it can rebalance. It can rebalance up to all 5 of them every single day, based on a bunch of criteria. Um, for risk control, I've got we've got stop losses on the back end. So if something we own goes down too much, we kick it out. But we've also got filters prior to any buy. So if something is down more than a set amount, we just skip it and we just go to cash for that day. And that's the buy and holdish part. This week actually we've had a whole bunch of positions filtered out. Not surprisingly, because the
Yeah.
market's been has been not great. And the selection process often, and maybe even more than often, usually is choosing stocks that are down on the day. And but when they're down too much, um, they usually snap back, and that's why, in fact, why the model works. But every once in a while, that down day, if it's especially if it's a really big down day, is a precursor of some real trouble lurking under the surface. Um, for instance, back in March of 2023, when the banks started going under, um, I forget which day it was early in the month. All 5 of the systems picks were bank stocks, and they were all down like 20%. And like, oh, no, 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 something's going on here. Something, sometimes I get buried in the ups and downs in the market, and I don't look at the news. I didn't know what was going on, but I knew something was wrong. And it's the filters that keep us out of situations like that. So that's when they kick in, and as they kicked in a few times this week, that raises our cash exposure. But when the market is going well, we're usually 100% in.
Would that just be for those stocks that cash exposure? Like if it was, well, I guess my first question is the five stocks, are they equally weighted
No, they're
or
not.
no? Okay.
No,
So then, oh, sorry.
no, sorry. This is just about market timing, and I already blew through these. So just a little bit about I'll answer your question in a second. I'll give you the back history of the model. It's called Fresh. Um, it was developed by Gordon Thompson, who I've been working with him for 20 years. We worked at the previous firm together. Gordon has never met an acronym he didn't like. The original acronym for the stock selection system was based on, he said it's Gordon's ultimate estimate of stochastics and statistics, which works out to guess. And when I explained to Gordon that that's probably not the best idea. If we want to get adoption of this by individuals and by institutions, we probably don't want to call the model guess. So he came up with Fresh. And to be honest, I don't even know what it means. I did like guess a lot. It was a little bit tongue in cheek, but anyway, it's Fresh now. But he started working on this in 2015. He became very much enamored with the idea of using statistics and probabilities to pick stocks that were likely to outperform. So he worked on this. This was a huge project. He worked on it for almost 6 years. He had a couple of stops and starts. The data acquisition and the processing power the requirements are immense. And for the first couple of years, he just wasn't able to do what he needed to do. He was able to do it and do the research, but there wasn't enough processing speed in computers then to be able to generate the signals in real time. So in May of 2021, we finally we got everything dialed enough to begin the beta testing. And then after a couple of years of that, we looked to refine it and make it a little bit more real world friendly. And that's when we added our risk controls and the money management. And what is my next slide? So Fresh works. It works on almost anything, which is really more testament to the statistical background of it. And this is not PhD level statistics, although Gordon is a PhD. This is the kind of statistics you learn in college. It's nothing really crazy. It's relatively straightforward, and the probabilities also. But what we do is we create a distribution of returns over the recent past for all the securities within the universe. In the universe, right now we're using the S&P 500, and we've also got a second one for the NASDAQ, but it could be anything. If somebody came to us and said, I've got these stocks I want you to look at, and can you pick the ones that are likely to outperform? We can run it. The bigger the security set is, the more likely it is that you're going to get actual results and not just noise. So the S&P 500 is good. Russell 2000 is even better, although you start running into liquidity problems there if you're picking smaller stocks. But you look at everything within that universe. You look at some recent returns, and you create a distribution. You create a curve out of that, and then you compare using statistics that curve, for stock one with the 499 other stocks in the S&P 500, and you rinse and repeat, and you just keep doing that over and over again. That's the intense processing power. Once you've made all those comparisons, you can rank using some as I said, the college level statistics and the probabilities. You get a probability of each of those securities being more or less likely to outperform its peers. And so we just rank them from 1 to 500 based on that probability number. And as the system is constructed now, we're going into the top 5. And I'll show you a little bit later in another chart. The top um, the top ranked securities over time tend to do better, but it's not a slam dunk. They don't always. So we weight them a little bit more heavily. We weight number one higher than we rate number five. But it's not, it's not, so it's sort of concentrated, but it's not, they're not grossly over or underweighted. We've looked at plenty of times. We've looked at holding more than five securities. The results aren't that much different if you look at 6, 7, or 10 that you're holding, and we look at weighting them equally, and the results really aren't that much different. You get slightly better risk numbers, slightly lower returns. So we've been doing it this way with five and higher weighting to the lower ranked securities, and it's been working well. So we're just sticking with it. And then every day we do that. We look at 10 minutes before the market close. We get all the data for the day for the past couple of days that we're looking at. And we run all those ranks, produce all the numbers, and then we get a list of the five top ranked securities. And if we're holding or if it's changing, we just make the change. We just do a quick rebalance. Usually it takes about 2 minutes. So we trade very close to the end of the day. And the idea is to try and get as close to closing prices as possible.
Got it. Okay. So then in the case, like going back to 2023 when you were in the bank stocks, if you choose not to go into them, you said the rest is you just go into cash then for
Just
that
go,
percentage?
yeah, we just go to cash because we know we're going to be rebalancing everything the next day anyway. So if we go to cash, we're not going to be in cash for very long. And it's usually not, usually I would say out of on any given week, so 5 days and five positions, so there potential of 25 positions. We might have one or two go to cash for a day. It's not very much. It's not very often that happens.
And then the rankings, how often do you see the five switch? Like how often are you actually not just changing the percentage to that security, but actually switching in and out new securities?
We'll see them pop in and out for a couple of days.
Mhm.
And then they'll go away when things are working well. They'll pop in because the stock might get hit, and then it'll float up to the top of the ranks, and we'll buy it. And sometimes we'll hold it for another day or two. Then usually it's either it does well and outperforms, or there's something else that's become, the system is ranking higher and more likely to outperform, and so we swap out and into that new one.
And then this has been live trading. I think that was on the other slide. Was it 2020?
Yeah, we've been so the as as we're currently running it, dating it back to April of 2023.
Okay.
That's with all the risk control measures in place as we're currently doing it. We've been doing actual trading on and off, but mostly on since about 2021. So we've got about little over 3 years of history
Okay.
doing this.
So yeah, so that would have 2022 in there as well. What are you seeing with the consistency through like the different markets? Because we've had at least somewhat of different markets within those 3 years that you've had the trading.
Yeah, I think what's I think is most interesting to me is a market timer, at least on the bond side, is that I've noticed when before a decline, often the system starts struggling. So it happened at the end of 2022. The market was still going up, and then all of a sudden our returns each day were flat. What is going on here? This is really annoying. And then 2023 happens, and then on a smaller scale, it happened last week. We were doing well. We're having a couple of nice days, and then we started going flat again and started dropping, and the market was still going up. And of course, I didn't put two and two together. I thought it was just, just a little bit of noise. And then, we have this pullback last week. So I'm not sure that I would use it as a timing model, but it does seem to be a precursor to moves. And then, yesterday, I think yesterday was a very good day for the system, and Wednesday was a very good day too. It picked stuff that rebounded. So it on shorter time frames, it does seem to lead the market a little bit, which is interesting. I mean, this year has been pretty good. I think the S&P system is doing it from memory, and based on last Friday. As of last Friday, it was about 21% for the year, and that's with none of the big seven. I think we might have had Apple for like one day was in there, but it's all been smaller names. So we've been doing this. The system has been working, with the names that haven't been doing well all year, and it's been able to find some decent returns in there.
Awesome. No, thank you for that. I like that.
So this chart is this takes a little bit of explaining. It's the return. The gray line is the return for the ranked stocks in the S&P 500, and it's additive. So the point all the way to the top left, that's the return over 15 years. If you had been only in the number one ranked stocks, you have 100% of your portfolio in that number one ranked stock each day over the last 15 years, you would have compounded out at close to 30%. That's what that's showing you. And then as you move to the right, the next data point is the effect of holding two stocks. And this is equal weighting. It's not how we're running money, but the equal weighting in this chart shows 50% in the stock ranked number one, 50% in the stock ranked number two. And then as you march down the line, it keeps adding another ranked stock, and each stock is getting its equal share. So what you see is sort of, it's like an S curve rotated on its side. So the top ranked stocks, the ones that are all the way to the left, tend to do better over time. And then as you add them, more and more, your returns start approaching the rest of the market. It's never going to look exactly like the S&P, because this is not, you're not adding all 500 names of the S&P as you're moving to the right. You're adding the 500 ranked stocks, and they could be, the ranks are jumping around every single day. What could be ranked number one today might be 250 tomorrow. So this is only dealing with the rankings. But as you go deeper and deeper into the bench, your returns start dropping and dropping. And then Gordon prepared this chart, and what he's done is at about the midpoint, when you've got all 500 stocks in there, and in each getting one 500th of the portfolio, then he starts dropping off the higher ranked stocks. So now you're getting rid, as you move from left to right. Initially, you've got the good ones, you're adding the poor ones. Then once you get the halfway point, you're dropping off the better ones, and you're being left with only the bad ones. And so what you see down the bottom is, if you only owned the worst ranked stock over the last 30 years, you would have lost about 10%. So it works.
So the far right is just one stock?
Far right, all the way to the right is just what would happen if you owned every day our worst ranked stock on to 100% in your portfolio.
Okay. So then because you said it went from 1 to 2 and so on, where does it start declining then on the chart?
So it starts, there's a lot of noise. If you look, that big drop off is at about 15. So at about 15 stocks, that's where your gains really start to stabilize. So it really makes no sense to go beyond about 15 stocks. We've settled on 5, as I mentioned before. 7, 8, 9, 10 also work. We've looked at a lot of them, but we try and stay as far to the left as possible, but also, maintaining a somewhat diverse portfolio.
Okay, I see it now. Does that go up to 1,000 then?
Yeah, it's about 1,000 because if you got 500 stocks in S&P, you've got 500 ranks. So it's adding one, two, three, four, five, all the way up to 500, and then it's taking away all the way to the last 500. So
Got it now. Makes sense. Thank you.
it's a very different way of looking at things. It's a little bit confusing, but what it does, I think what it shows very clearly is that the ranking system works. Especially if you stay within the top, 5 or 10 stocks over time, they're going to pick this approach is going, this approach did pick. I should be careful with my tense, in case any regulators are watching. This approach did pick stocks that generally outperformed over time. And the same is true with the negative stocks. But the interesting thing, and one question I get asked a lot was, is can you short? Can you use the poorly ranked stocks to short? And the answer is that you can. But if you look at the returns on the short on the lower rank side, owning only the worst ranked stock would have, if you've been short, would have made you 10% versus gains of owning the long stuff, pushing 30%. So you can do it, but because of the general direction of the market over this time, it's not as profitable on the short side as it is on the long side. And then you've got cost of carry, and you've got to find the securities, and it's a whole other ball of wax. So we stay away from the short side for now.
Yeah, especially if you can do it on the long side and do it better, why even bother?
Yeah. And we've got, even just the last couple of years, when we've got the documented real-time record, we're doing, as about as well or maybe better than the S&P with lower drawdown. So, it works.
I'm just taking in that chart now that I
It's
understand
a
it.
it's a lot. It's a
Yeah.
lot. It took me. I had to have Gordon re-explain it to me again today. He's explained it to me 3 times. You're gonna get mad at me, but I gotta be able to break this down for people so that it's not that confusing. But yeah, it's the key to remember is that you're adding lower and lower ranked positions as you move to the right, and the returns are lower and lower as you move to the right. So sticking with the higher rank stuff should produce better returns.
Cool. Well, I'll continue to look at that because when you sent me the PowerPoint and I looked at this the first time, I'll admit I was like, wait, what? What am I
Yeah.
looking at here?
Yeah.
I'm
Yeah.
sure it makes sense, and now it does. And it's funny how amazing a chart is once it makes sense. When you're looking at it at first and you don't know what it's saying, you're like, what? But then
Yeah.
once you understand it, it's just like,
When the
yes.
light bulb goes off, and
Oh
then
yeah.
the frustrating thing is, like me, the light bulb is going off, and then I don't look at it for a couple of days, and I want to show it to somebody, and I can't remember what it was all about, and I have to have it explained to me all over again.
Been there too, so I completely get that.
But
Is there
I
anything
don't
else? I
remember.
can't remember. Is that no, there
Yeah, I
is.
don't remember. Yeah, so that was pretty much it. The thing I want to point out, and this is well based on the real time data. The one thing I think is really interesting. I looked at just before we got on. I looked at the daily correlations of our real time record, and the correlation to spiders was 0.551 on a daily basis. I'm picking from among the S&P 500. That's the universe. And that correlation, that's the R. That's pretty low. That's very low. And the correlation to the Qs is even lower. And just as as a reference point, the correlation of the spiders to the Qs is as you would imagine, is 0.918. So they're very highly correlated to each other. But the results of the system is very weakly correlated. I would say at 551. So it's an interesting thing to throw into a portfolio. And we've seen it working with a couple of institutions. We've thrown it into their portfolios is just, even just as a small piece. And it tends to boost return. It tends to drop risk at the same time. And you can even do that with, for somebody who's, a dyed in the wool passive investor. Just a little bit of something like this to your passive, spider buy and hold strategy does wonders. It does wonders to your risk.
So you have this out there right now, you said, with some institutions out there.
Yeah, we're working with them to get them on board. Still providing marketing materials right now. It's still all relatively new. I've got and I'm taking individual accounts, but and happy to take them. But it's really getting it into the hands of institutions. One's a mutual fund. And the other's well, the mutual fund and an RIA, and the other's a more traditional RIA. That's really that's our focus for now is trying to go that route.
Would then you be like kind of like a sub-advisor relationship? Because I would think the signals, you wouldn't be able to do anything signal
Yeah,
wise because it's 10
no,
minutes.
there it's too too bam bam. You have to. We've got a 10-minute window to get the signals out and get them traded. So yeah, we're doing it as a sub-advisor. We use interactive brokers, and the technology makes it super easy. And right now, we're still doing it. We're still doing it manually, just rebalancing the portfolio and using groups. We could. I don't know if I ever really want to do this, but it would be fairly straightforward to use to build APIs and just have the signals go straight through, either straight through to IB or straight through with a human just pushing the final button. But IB is they've been a great partner for us. They do. They make a lot of the hard things very easy, and doing like a rebalance of an entire portfolio 5 minutes before the market closes is one of those things that they make easy.
Oh yeah, no, they've helped out a lot of name members for sure. So
And that was pretty much it that that's it to the presentation that I wanted to show you.
well, perfect. No, I like that a lot. I'm still thinking about that previous chart.
I'll
But
just put it back up here so you can look at it.
and then I know I asked you before we got on about just your favorite investment related quote. So if you want to share those.
Well, as a longtime system trader, my favorite one is the market can stay irrational longer than you can stay solvent, which has a lot of meaning for anybody who's ever run a system and then overridden it
Oh, yeah.
because they thought they knew better, or because they thought the market was wrong or the system was wrong. And what I've found is whenever I've done that in the past, and I've regretted it.
Yeah.
So the market is what it is. It's and fighting that generally doesn't pay off.
So with this strategy, if even if you feel not like in line with it, you just follow whatever it says.
Yeah, for yes, I'm absolutely following it to the letter. For if you remember in the one of the previous slides, I said we've been trading this since 2021, and one of the things that I had been doing early on was to see if I could beat the system.
Mhm.
Not with picking different stocks. I would pick the stocks, but I would try and adjust the allocations up or down, not not relative to each other, just cash in the portfolio. And I would also occasionally see if I could be smarter than the system and get out of stocks earlier in the day if I had a nice gain. And I wasn't, and I couldn't. So right now I don't.
We
But
found the same thing. I like to try that too on my end, but I even if you beat it a few times, you lose a lot more often than you end up.
yeah, and to that point, it was it's good to have those test accounts because you do get to play around with stuff like that. And from that, that gave us a whole avenue of research looking at getting out early based on price targets or using adjusting, trailing stops to try and do it. And it helps spur ideas. And there are a lot of other things we looked at, but in the long run, it seems to be better just following the system and just letting it do its thing.
Well, definitely. No, I agree with that 100%. Any other final thoughts before we close up?
Um, the other thought was the other quote that I was thinking of, which is that it's different this time, and that always makes me think of the Heisenberg uncertainty principle because it's both true and not true at the same time. It's not different this time. It's always going to be the same, because markets are based on people and people don't change. But it is different each time because it's everything's a little bit different. It's sort of like a fractal. It depends on the time scale you're looking at. But if you zoom out enough, it's all pretty much the same. So it's we'll see if it's different this time. This right now, it's looking like the Fed has engineered a soft landing, which would be, I think it might be the first time, maybe if you count 94 and 95. So maybe the second time in my professional history when the Fed has been able to do that. So I think Danielle DiMartino Booth, who's going to be, I believe, I'm hoping, is going to be one of our speakers at the conference in Dallas in October. She's been saying that in a couple of months, we're going to look back and we're going to say that the recession started last October. So we'll see if she's right. I don't want to argue with her because she's smart. But on the face of it, you look at the way the equity market is acting, and maybe they did pull it off. Maybe it is different this time, but we'll see.
Time will tell, and I will see you out there in Dallas in October. I'll be going to Outlook.
I'm looking forward to it.
Well, definitely. Well, Jim, thanks again for coming on today. I really enjoyed our conversation, learned a lot, loved the chart. Said it a few times now.
Feel free to call after we're done and I'll talk you through it, walk you through it again. I have other stuff. I didn't want to even more noisy, but I didn't want to blow your mind.
Yeah, there is a I forget the name right now, but another name thing that we do where we share a chart. I think it's Thursdays, or I'll have to ask Susan which day it is. But have you ever performed or shown these in that?
I have not. I don't know that the name is ready for this nonsense. What I did it once, and I showed the option adjusted spread curve for high yield bonds a couple of months ago, and I think that was more everybody's speed. This is a sort of a select group of quants who really want to dig in. Might find this interesting.
I don't know. I would say you never know. It always surprises me at names, so might be worth a try.
Maybe I'll give it a try, and if they don't like it, I'll blame it on you.
Perfect. All right. Well, awesome. Well, thanks again. And I know next week for NAAIM Confidential will be an interesting episode because we're having all of the speakers just kind of give a recap on what we've learned so far with this. So definitely tune in next week. And once again, thank you, Jim. I'll catch you all with the next one.
Thank you, Ben. Looking forward to watching next week.
All right, cool.